Hello everyone, welcome back to my YouTube channel. Today we are going to talk about a very important topic, that is the overall strategy which bank use how to business in the credit card area, or I would if precisely say it, what is the strategy of credit risk management, how the overall business of credit card, the whole life cycle of credit card, how that actually works with respect to the models which are getting generated to avoid the credit risk involved. So this video is for all of you who want to understand all of this. By the end of this video, you will get all of this. If you are very first time on my YouTube channel, please subscribe. Please like my videos. I usually make content like this. Okay. Now, without spending more time on this, let me take you forward. Let's start discussing about the things directly. Okay. Now, as I mentioned, this is overall about the overview of the credit card strategy. Of credit card strategy and credit origination. Number one, this is topic number one. Then topic number two is life cycle discussion. Life cycle discussion of credit card from the perspective of scorecard models. So this is going to be the topic for the day. Okay. Now, primarily, when we talk about the strategy, let's start directly with the flow diagram. I'll make a precisely important flow diagram. You can understand everything if you follow this completely. Now, I want the full window. Okay. I think things are very clear to all of you. Now, let's talk about the credit card strategy. Now, when we talk about strategy, so there are three type of credit card strategy usually which bank follow. So there are three type. Number one is acquisition. Acquisition strategy. Number two, here is behavior strategy. Number three is your business strategy. Now, what is the difference in three of them? So, acquisition means when you are acquiring a customer, the customer who are new to the bank, they are very much new to the bank. We call a term NTB. So, those customers are known as new to the bank. So, for them, we use the acquisition strategy. For the customer who are already part of the banking system, they are known as behavior based customer because they have a behavior with the bank. Obviously, they are having any product from bank. Then there is a business based strategy which is totally depending on the type of product which our bank are launching. So bank usually see who are the potential customer involved. To them, they want to make part of their credit card selling strategies. Okay. Now, when you talk about overall acquisition, so in acquisition there are two important things. When you are acquiring a customer, there are two things which bank usually follow. So number one is the cost, how much the cost need to be bear as a bank, and second thing within this cost is like the second component of this cost would be the benefit, like overall benefit which the bank is going to draw from acquiring a particular customer. Now, when you talk about this cost, so cost is the combination of risk weighted assets which we call RWA and expense, like how much the expense the bank is going to make. Now, what is RWA? I will tell you. Before that, let me tell you about expense. So when bank is having a credit card, so bank is investing some amount of money by giving some payment, like some cut of the payment to, let's say, Visa, or MasterCard. Then when the bank will be doing all your KYC, so there is a cost involved there when you are acquiring a customer. Then you are going to dispatch the credit card using the post or any particular courier service. So that cost is involved there. Okay, that is all known as an expense. Now the bank usually try to minimize the expense. That is one thing you all should know. Now we talk about risk weighted assets. So what is risk weighted assets? Okay, so whenever you are giving a credit card, so when you are making a credit card, you are giving it to a customer. There are two chances. There are only two stages. So stage one, the customer will draw the amount. This is drawn amount. Then there is an amount which the customer has not drawn. Non-drawn amount. Now what is the meaning of this? Let's say there was a limit of 100 rupees of the credit card. So customer spent 70 rupees, that is drawn amount. Then 30 rupees which is left is undrawn amount. Now if I mention the 70 rupees out of 100, this was the 100 rupees limit of the credit card, 30 rupees. Now one thing you should know, this 70 rupees is a balance sheet thing. Balance sheet. This amount will be captured in the balance sheet of the bank. This 30 rupees will also be part of the off balance sheet, not the direct balance sheet. This is off balance sheet item. Now the combination of these two is considered as a risk weighted assets. So the combination is 100. Now whatever the limit of the credit card you are giving to your customer, okay, this limit overall is known as a risk weighted asset. Also, if I give you one more example, let's say I'm giving the home loan of 1 crore rupees. So initially when the loan is starting, that 1 crore plus the interest is known as a risk weighted assets. Okay. Now when you talk about the cost, so this was the first component, this was the second component. I hope this is clear to you now. Now we talk about the benefits here. So what is a benefit bank is having? Obviously bank is doing a business, not charity. So bank will have two type of income earning here. So the type 1 income is your interest income. Interest income. Second is non-interest income. Non-interest income. So obviously when the person is taking a credit card from the bank, they are going to pay some interest if they are not paying the full amount. That is known as a interest income by the bank. The non-interest income are which are not directly related to the interest. Sometimes late payment fees is there. So those kind of things are part of non-interest income. So these two type of income which our bank is generating directly from a customer. Okay. Now customer is generating these two type of benefit for the bank. This combination of benefit, when you make the sum of interest income, then the sum of non-interest income is overall the combination called as ROI, which we say return on investment. So this is what bank call as a ROI. So usually people ask this question, what is the ROI of this product? What is the ROI of this business? That is the meaning that return on your investment is known as ROI. Now this particular ROI is further obviously very important for bank, because bank want to increase the ROI on the investment. Everybody knows this. Okay. Now to create the maximum ROI, bank need to do what? Bank need to create a segment of customer, and there is a reason for that. See, credit card is a retail portfolio. Okay, retail portfolio always have plenty of customer, like 1,000 lakhs of customer. Okay, now there would be, if I take the example of India, in India there would be like lakh of people who are using the credit cards, right? So for bank this is very good opportunity to make the segment of the customer. Bank will make segments. which will keep homogeneous type of customers together. Okay, let me go a bit down. Okay. Now, what is segment? I just said it's the homogeneous group. Similar characteristics type of customer will be segment together so that bank can easily target those buckets where they want to generate the maximum return on their investment. This is very much tricky. I hope this is clear to you. Now, this segmentation is further obviously need to calculated on the basis of the risk profile of those customer. Okay, this segments, let's say I say segment 1, I say segment 2, then segment 3. These are the customer who are the highest risky, these are medium risky, these are least risky. This segment 1 is generating the maximum profit. So obviously the operations team in the bank, they will target those customer more and more by selling them more products. Okay, now these will be having similar risk profile, which is risky. This risk profile is moderate risky. The third risk profile for third group is least risky. Okay, now this segmentation is further done on the basis of two things. One is on the basis of business, which I just explained to all of you. Obviously, there is a business riskiness, profit, all those things. Then there is a second type of segmentation, which is based on the statistics. So people read statistics in banking so much. The reason is this, because statistics is used to produce so many important aspects for us to generate profit as a bank. Now, in statistics, if I say this is further divided into two types. So, statistics on the basis of decision tree, which is a algorithm. The second type is your random forest. So bank will use these statistical techniques to increase their profit to the maximum limit. Okay. Now this was about the acquisition, overall acquisition portfolio. I hope this was clear to you. Any question, please put in the comment section. Now let's talk about the behavior strategy. In behavior, there are only two things you are trying to do. Either you will do the credit limit increase, I stands for increase, or the second thing in the behavior would be credit limit decrease. Why so? Because if the behavior of the customer is good, so you can increase their credit limit. And in real world also you might have seen that let's say your credit card limit is 1 lakh. Now you are a customer of the bank for 2 years, so you will get a call from the bank that we want to increase your credit limit to 2 lakhs, something like that. Then there will be a decrease. If you're a bad customer, bank have the right to decrease the credit limit which you have. Okay, this much you should know about the behavior part. Now let's talk about the business part. In the business, there are two things. Why business strategy is important? Because using the business strategy, bank usually try to do two things. Number one is about overall cross sell of the products. So we call it cross sell. What is the meaning of cross sell? The good customer are, let's say there is a bunch of good customer in credit card. So you know that they are paying everything well in advance. They never default in their payment. So bank will try to give them more product. Let's say try to give them FD, try to give them loan because they are very good. Try to give them more products like mutual fund and other insurance projects, insurance products, I mean. So similar thing is known as a cross sell. That's why this business based strategy is involved there. Then there is a term called, second one is upsell. So let's say they had a credit card which was a lower category. So you try to give them, upgrade them into a higher category credit card, which is going to give them some meaningful advantages. Now their limit will be like, let's say earlier limit was 5 lakh. Now your limit is 10 lakh. Earlier you could only visit 2 airport lounges. Now you can visit every quarter 4. So this is known as a upsell for good customer, and cross sell is selling them, let's say FD, or selling them mutual fund of the bank, or any other product, maybe insurance. So these are 3 type of strategies. Okay, I hope all of this is clear to you as of now. This is all about the credit card strategies. Let's move forward. Let's talk about some important life cycle thing now. Okay, so I'm going up now. Let's go. Yeah, let's start about the overall life cycle. So before I go to the life cycle, for a customer, there is always an opportunity in the bank. Okay, so I mention this as a customer opportunity. Why I am saying that? Obviously because bank always work on the profit side, and how you do that? When you see the customer opportunity analysis. So how this customer opportunity analysis works, I know my writing is not so good, but I hope I'm covering all that verbally also. Okay, now in customer opportunity analysis, you will always check that there are existing customers. Number one. Number one is your existing customer. Then in your analysis, you will always have new products, like your new credit card launch, your new loans launch. All those things are part of this strategy. Okay, now in existing customer, you will always try only active customer. You will try to approach the active customer more and more, because they are more aggressive towards the spend or purchase, all those things. Okay, now these customers are already active in some overdraft projects, or which bank is trying to give them any overdraft limit. So these are the active customer. Okay, when you are doing this analysis, you need to examine these kind of customers, or maybe your credit card already they have. So these kind of customer are known as active existing customer. Now in this active existing customer, there are 2 type of things you will try to upskill them. Number one is your charge cards. So let's say any customer is having a card which has annual fees. So you will try to give them the chance that we can waive off your annual fees if you upgrade to a new credit card. Or you will try to sell them co-branded cards. Because when the bank sell the co-branded card, the profit sharing happens, but at the same time profit increase. Because let's say if I give you a credit card where you have like oil purchase and you're getting good points, so it's good for the company, you are purchasing more oil, and it's good for me as a bank, because now my spend is through my system only. Obviously you're purchasing from the oil company, but spend is through my system. So this is very much important. So now you have a new product here. So you will always try to give this to the active customers, which are, let's say you have a credit card launch. After so many campaigns, you have a credit card launch. So you try to sell this new product to your existing customers, which are active and already using any particular type of product from your bank. Okay, now after this, the most important thing is to check the criteria when you are giving them the card. So first thing bank will do, always check the criterias. Now here, after this, let's say I make a diagram credit card. So your first step is new credit card is launched. Now you will check the criteria. Second thing is your criteria. Now in criteria, the number one thing which bank always check is the, we call it sometime BRR, or risk ratings. What is the meaning of BRR? Borrower risk rating, or we call it directly risk rating also. So both are same things. Bank usually do this when they are preparing the scorecard or the whole analysis. Now using this particular strategy, I am going to tell you how you will make a full scorecard. Okay, so you have the borrower risk rating or the riskiness of the customers. You will check this. Now on the basis of this, there would be some component you are going to check. How you will check the riskiness? Using the delinquency. How much the customer was delinquent. Number one, delinquency, all of you should know. If you don't know, please put the comment, I will reply to that. Okay, then second is the utilization, that the customer should be utilizing our product, otherwise there is no point, right? Active customer should be utilizable customer, otherwise we are selling the product, they are not using it, then there is no point, obviously. Then third thing is their payment behavior. How much scheduled payment they used to do, they were not flouting any payments, they were properly aligned with the payments, all those things you will be doing here. Now all these three things, this whole bunch which we created here is converted into behavior scorecards. This is very important. Okay, all this is converted into your behavior scorecards. Now this behavior scorecard, obviously always take the data from internal and external. So there are two type of data. There is internal data, which is bank's own data, because this is a behavior scorecard, so the customer is existing in the bank. Then there is second type of data, which is bureau, which is data bureau like Equifax, Experian, all of them. So they are also providing the data. Bank is having their own data. Bank is mixing this two data on the basis of the customer ID, then they are producing the main data. Now in this criteria, this is very important that these three things are addressed. So criteria number one was BRR, which I mentioned. Now let's talk about criteria number two, which is very important, and we will talk about it. That is credit card type. Now what is the meaning of type? What type of credit card you are going to disburse, like you are going to give to the customer. So there are two type of credit use. Okay, and moreover, I not say credit card type, it's credit card use type. There are two type of users in the credit card. Number one is your transactors. Okay, number one is your transactor, then you have revolvers. Transactors are the people who are, let's say, spending 100 rupees, they are paying 100 rupees. So there are very less interest income bank is making, because they are paying everything on time. So transactors usually bank don't prefer. Bank like revolver, let's say they are spending 100 rupees, they are not paying full 100, they are paying 70. 30 is a balance which they are going to pay next month. Now on this 30 I will put a interest, so they have to pay me 33 next month. That's how this whole life cycle works. So I spoke about this, right, when we were starting this particular diagram. I said it was the credit opportunity analysis. So that's how this whole credit opportunity analysis works. Now I made a scorecard here. Okay, I have the behavior scorecard which I mentioned. Let's go a bit down so that I take it forward from here. So in the end, I mentioned about you have a behavior scorecard. So you have the scores for all those things. Let's say riskiness had some score which is 30% out of 100. See, the scorecard is always calculated from 100%. So this is something you should know. So riskiness was, let's say, 30%. Then there was utilization, which is again having a weightage of 30%. Then you have payment behavior of the customer, which have a weightage of 40%. Now you will give them the score from 30, and in this you will give them the score from 40. So on the basis of this, you will create a scorecard. And there are two cases. So let's say the behavior score is greater than some particular value x, or the behavior score is less than x. Similarly, there will be so many conditions which will be given to you by the business, and according to that you are going to create your code. This is simple. Now we are all clear. This was a whole strategy. We have built the scorecard. Now we talk about validation quickly. I have made dedicated videos on validation also, so you can go there and you can talk, you can check about all those type of tests. Now on this whole thing which we have built as of now, we are going to check certain thing. We will check the rank ordering, that the rank ordering of the variable should be perfect. This is very important. This tells about the overall ordering of the whole model or the variable used within this. This is a part of validation. Again, we will check the concentration. Second thing, that what is the concentration of the variables which are used. This is done by the model validation team, not usually done by the model development team. This is MV, sorry, not MD. The whole work which we did up there, that was done by the model development. So we do the concentration test. Okay, this is second type of test. Then we do the stability test. Okay, so I think it's all clear to you. So I just wanted to talk about these pointer in this particular video, and I hope you like the video, because this was totally from the perspective of FRM. If you are aspiring for FRM also, if you are aspiring for a credit risk job, this is very important for you. If you like the video, please hit the like button, and please do put your comment if you like the video. If anything you don't like, please put it in the comment section, but please subscribe to my YouTube channel, and please share this video with your friends and colleagues. That actually helps me to grow more and put my foots more in front. So thank you so much. All the best, guys.